Rate surge, stocks plunge. That was the big concern yesterday in markets over the whole debt ceiling debate. This is the issue going on right now as stocks continue to worry about this whole idea of a debt default. Look, let's put this into context. We have raised the debt ceiling 78 times since we started doing this process back in the early 1980s. And again, every time we get to this point, we raise the debt ceiling. We've had government shutdowns. They come, they go. People go back to work, and we always make the interest payments on our debt. Has there ever been a time we haven't made an interest payment? Has there ever been a time the U.S. has defaulted on our debt? Yes, 1979, we missed an interest payment. Why? Because we failed to raise the debt ceiling in time, and there was a technical default on bonds. But look, nobody really panicked because why? It was ultimately a function of just a mechanism in the system, and everybody knew as soon as the debt ceiling was raised, interest payments were going to get paid. It was a technical default, not a real default. And those are two very different things. A real default is when you simply can't pay your debt. That's not a problem for the U.S. So yes, interest rates did spike here over the last couple of days over concern of this whole debt ceiling and the potential for missed interest payments. But as usual, we will resolve this issue. Now, what happened in 1979 after the debt default? Well, immediately interest rates fell back to where they were previously. And then, of course, we got into late 1979 where we got into the whole oil crisis embargo. That was a different thing for interest rates at that point. But every time in history where we've had an interest rate spike because of the debt ceiling, let's go back to 2011, whole debt ceiling debate issue there. Yes, concerns over a debt downgrade, missed payments, interest rates spiked up. But as soon as we raised the debt ceiling, what happened with the rates? They went back down to even new lows. So again, one thing to expect here is that yes, in the short term, interest rates are certainly pushing higher. That's impacting growth stocks, in particular in the markets, which are longer duration securities. With the market now sitting on the 100-day moving average, we're retesting this low that we set here just last week. Again, it'll be important for stocks to try to hold that. We are looking for a bit of a bounce in stocks today. Stocks are oversold here on a short-term basis, but we are still maintaining our money flow buy signals. Volume did pick up on the sell-off yesterday. That's a bit of a concern here. But the one thing to really watch is this 433 level on the SPY, because again, a break of that would suggest that we're going to try to set new lower lows and potentially start to look for 411 on spiders, which is where the 200-day moving average is as well. So there is certainly risk to the downside. However, I suspect that as soon as we get this debt ceiling raised here in the next day or two, this will resolve itself. Markets will stabilize. Interest rates will come back down. Unfortunately, at the moment, this is one of those times in the markets that if you didn't prepare for the decline in advance, this is going to be a period you just kind of work your way through it. There's no safe place to hide. Bonds aren't working. Stocks aren't working. The only thing is working right now is cash. So again, just going to have to wade through this here for a little bit. Again, if we do break support, we can make some other decisions at that point. But right now, we don't want to make any emotional decisions because, again, this is still just a normal correctionary period within a market that's already up 17% for the year. Again, been a very, very strong year here, just a normal correction within that process. So again, don't overreact emotionally here. Let's be logical about our positioning and look for opportunities as we get through this period. I'm your host, Lance Roberts, for 3 Minutes on Markets and Money. See you back here tomorrow.